I would say that the banks certainly have underperformed since August 1st, which of course is when the president came out with the 10% tariff announcement. And when you take a look at the bank stocks since then, they're down anywhere from 11 to 12% versus a general market decline of about 4.5% to just over 5%. And the flattening of the yield curve is the primary culprit, in our opinion, of this underperformance. As the long end of the curve has come down, that has certainly weighed on the bank's profitability, but has also affected these stock prices. So they have clearly underperformed the market since the 1st of August.
Gerard, the point has been brought up. There's a debate out there about just how important the yield curve is in any capacity, the difference between long and short-term rates to bank profitability. Are yield curves important for banks?
They certainly are. And actual nominal levels of interest, of course, are important. But as important is the steepness of the yield curve. And as it flattens, the industry's profitability is affected. Now, the industry and the larger banks in particular have ways of offsetting the flatness, and certainly when they drive their fee revenue growth, they're not as vulnerable to the flattening of the curve compared to a bank that has 80 or 90% of their revenue coming from lending. So it is very important. But one other real importance about this yield curve is I know everybody's concerned about a recession, and we've seen the evidence that when the 210 inverts, recessions can follow anywhere from 11 months to 24 months after the inversion. However, in the past downturns, the inversion comes from the front end of the curve going up and not the long end of the curve going down. So you hate to say that this time it's different, but it truly is.